Welcome in. So this is exciting. I have Rob Campbell with me, master of all things tax. Just kidding, that's not his title. That's probably close though, but we'll get to him in a second, and we'll talk a little bit about his background and what we're going to be talking about today. And in that, this is a little bit of a different format too. What we announced last month in Webinar Wednesday was that we were going to move to not being live. We're trying to come to you guys when you can watch us. So hopefully you're somewhere comfortable, you're able to listen in, because we're going to get to some good stuff today. So thanks for taking the time to watch this. And as always, if you have any questions, feel free to reach out, because we can clarify anything that isn't clear. But I'm sure Rob is going to do a great job of explaining everything very thoroughly. Right, Rob?
I'll do my best.
Yeah. Okay, so with that, like I was saying, a bit flippant, but he really has been in this tax space for a really long time. So can you tell me a little bit about yourself and where you were born? Well, maybe not that far back, but just a little about you and how you came to be here at Omega.
Sure. So I've been in the tax industry for 18 years. Got my start here in Orange County, California when I graduated, working at a local tax consulting firm, mostly in the hiring incentive space and geographically targeted incentives. So if your business is in this part of town as opposed to that part of town,
I see.
There were special tax incentives both at the state and federal level here in California. From there, I wound up at a CPA firm for a couple of years and then moved to a larger CPA firm, doing more traditional tax and accounting work, as well as the specialized credits and incentives. I've worked on everything from the work opportunity tax credit to the R&D tax credit.
What's your favorite tax credit?
Well, my favorite's the R&D credit because
he's working on
it now.
Yeah.
Well, because I have degrees in accounting and computer science, and so I can actually speak the engineering
Do you
talk.
like it if people say like nerd alert? Is that like flattering to you? Some people like, how do you identify? Do I identify that way?
Yeah, I prefer the term super nerd.
Yeah, that's quite the combo. I love that. So very bright, computer science and accounting. I love it. Okay, go on.
Well, then I went to work for a large corporation doing the same sort of work at the enterprise level. So site selection, negotiated incentives,
Yeah.
a lot of data mining, trying to figure out, who are our employees and where are they located and what are we paying them and what sort of government incentives might be available in those different regions. So a little more sophisticated enterprise stuff.
Yeah.
Before really jumping back into R&D credits more than anything else for the last probably 6 or 7 years.
Wow.
So I did my first R&D study back in 2007. It was a 7-figure claim, and of course it got audited.
Yeah.
And so I got to really kind of go through the trial by fire, both at the federal and state level on that claim.
Wow. Wait, is that the story? So Rob, you told me, is that the one where you went through it, you were an attorney, but remember that story?
Sure. So the auditor was new to this particular tax credit program.
Yeah.
And so she was really focused in on one subsection around internal use software. Mm-hmm. And if you read the law in context, it says internal use software does not qualify unless it satisfies these additional tests. But she stopped reading at internal use software doesn't qualify. So in a sense, I was training the auditor on how to complete an exam.
And that was early on, right?
Oh, yeah. I was probably 22 at the time.
Wow. Cool. And that started it all pretty much, right?
Yeah, with the R&D credit, it's kind of interesting as I got to work more nationally and spent a lot of time on airplanes. Each state, for the most part, has their own flavor of incentives.
Yeah.
And there's roughly 38 states that have a conforming R&D tax credit.
Wow.
And if you hold your breath long enough.
Conforming? Which one is non-conforming? Do they dye their hair and wear lots of punk rock clothes? What's a non-conforming?
So
conforming?
You have like the federal definition of the R&D tax credit,
mm-hmm.
and then each state kind of has their own flavor in
mm-hmm.
terms of how they tackle it. So, for example, Texas
a nuance
mm-hmm.
to it. Mm-hmm.
So like Texas is a lot more strict around what is or is not R&D around software development than say other states or even the federal code.
Got it.
But if you hold your breath long enough, that number changes all the time. Oregon might have a credit, take it away. Louisiana can't make up their mind. It just kind of depends on what the current state level legislation looks like relative to the federal level.
Keeps it exciting, it sounds
For super nerds like me, absolutely.
Yeah. cool. And then you've been here at Omega for some time, and happy to have you here with your expertise. And that being said, what are we talking about today? Let's fill in our friends.
Yeah, so today's topic is the R&D tax credit under Section 41, the new 174 amortization requirements which are related to it, and then also the 280C election and how the three kind of interplay and work together.
So which part do you want to talk about first, Rob?
Sure. Well, let's start with the R&D credit.
Yeah.
Commonly known as the R&D tax credit in the United States. The name itself is a bit of a misnomer. It's also not the actual name of the tax credit.
Okay.
The actual name of the tax credit is the Credit for Increasing Research Activity.
Oh.
Which is a bit misleading. It does reward a business for spending more on qualified activities.
Okay.
But even if the spend is flat, you still get a tax credit. It's just the whole idea is to bring investment back to the U.S. And to create technical jobs.
Okay.
Now, when you calculate the R&D tax credit, there's a number of different ways to do it. Generally speaking, you're comparing some kind of base activity to a current year's activity.
Okay.
So oftentimes when we sit down with clients, they get a little flustered because we're asking for historical data, and they say, why are you looking at 2019 when we're talking about 2022?
Yeah.
And that's the reason, is we have to compare a certain base period relative to the current year. Now, when we look at R&D tax credits, we talk about the wages you pay people. We
Okay.
talk about supplies that might go into prototyping.
Got it.
We look at third-party costs, so if you have an outside company or individual that's assisting you with technical activities.
Mm-hmm.
And then we look at cloud hosting costs as kind of the four
Okay.
cost buckets. And essentially the idea is the higher the score, kind of like pinball, the bigger the tax credit. Where it starts to get interesting is the R&D tax credit is Section 41.
Okay.
And Section 41 makes reference to this Section 174.
Okay.
And so 174 is all the buzz right now because a whole bunch of new laws went into effect that basically say you have to take those qualified costs, those technical costs,
Got it.
and you can no longer write them off in the year that they're incurred.
Okay.
So if you had, for example, 10 software developers making $100,000.
Got it.
So you've got $1 million in technical cost, right?
Yes.
And the R&D tax credit, this isn't at all how it's calculated, but it's
Yeah.
roughly...
For example purposes only.
Yeah.
Yes.
It's-
Disclaimer.
It's roughly 10% of these qualified costs, right?
Roughly 10% of spend,
Mhm.
right? Okay.
So in this example, if we're spending $1 million on software development
Mm-hmm.
and our R&D tax credit is $100,000,
Right.
that $1 million, we can no longer expense it in the year that we incur it. We now have to
Huh.
amortize that cost. They say it's over 5 years, but it's a mid-year convention, so it's technically 6 years.
Wow.
So instead of expensing $1 million in wages that a business incurred, you now only expense $100,000 in the current year, 200, 200, 200, and then in the 6th year you get to expense that final 100,000 again.
Wow.
So for a lot of businesses, if you assume they have like a marginal tax rate, let's say it's 20%, 30%,
Yeah.
you're talking about an extra $200,000 or $300,000 in terms of income tax liability.
Yeah.
So at face value, it sounds terrible, right?
Yeah.
And it's-
Yeah. I'm concerned.
Yeah. And so it's encouraging businesses not to spend money on technical activities in the United States under this
Yeah.
new requirement. Now,
What's the thought behind it? Do you know?
sure.
Why would that come to be?
So a lot of times with government legislation, they're essentially borrowing against the future, right? Like everybody
Yeah.
always talks about the federal debt and things like that. So under the TCJA back in 2017, there were laws being passed that they essentially were creating tax cuts for businesses and tax cuts for individuals that they had to borrow against the future
Yeah.
in order to finance that activity. So
What's
it's like a short-term, long-term.
TCJA again? It's the tax.
The Tax Cuts and
Cut.
Jobs Act.
Yeah. Okay.
So as they made these changes, and then the PATH Act was the other one in 2015. As they made these changes, they were borrowing against the future. And so this is one of those tickets that now has come due. Now, at face value, it sounds terrible, right? Because you say, oh my
Yes.
gosh, you just increased my tax liability by like $200,000, $300,000.
Right.
But in that example, we do have the R&D tax credit as an offset for that.
Okay.
Now, some of the other things that help to ease that burden a little bit, the first one would be the qualified business activity deduction, the 199A.
Okay.
that was something else that was enacted back in that time period that basically says if you're a small business owner, whatever the profit of your business is,
Yeah.
you get a 20% deduction for that.
Wow.
So
Do a lot of small businesses know about that?
yeah, it's a pretty common thing.
Okay.
So most CPAs are familiar with 199A at this point.
Great. Okay.
But it was a novelty at the time.
Yeah.
And so what happens with 199A is because we can't write off all of these software development costs in our example, thinking
Right.
about, the $1 million in
Yeah,
software developers.
Back to our great example,
Yeah.
but just an example for example purposes. Yes. Go on.
So now that the company made $1 million more,
Yeah.
they're going to get a 20% deduction that comes through.
Okay.
So that helps to offset some of that tax liability that
I
they're
see.
incurring as they have to wait to expense those software development costs.
I see.
Now, the other piece that's kind of interesting that helps to offset that
Mm-hmm.
174 amortization pain a little bit
Yeah.
is a change they made to Section 280C.
Okay.
So Section 280C basically says if you claim certain tax credits like the R&D tax credit,
Yeah.
you can't also claim a deduction for the same amount.
Okay.
So in our example, if the taxpayer has $100,000 in tax credit,
Right.
they have to give up $100,000 in deduction.
Oh.
So it eats up some of the tax
really,
credit, right?
So now we're back to it sounds really bad to me.
Right. Well, that's how it's always been for a long time.
Okay.
Okay.
Yeah.
And so when we went through one of these R&D tax credit studies with a given client,
Yeah.
you basically have two options. One is to add back to income the amount of the tax credit,
Got it.
or you could make what's referred to as a 280C election, which says, I'll just discount the tax credit itself.
Okay.
And they both kind of amount to a similar thing. There's some tax planning that can go into it, and depends on how complicated the entity is and which states they're in, especially if it's like a pass-through entity with a lot of shareholders or something
Got
like
it.
that.
Mm-hmm.
But it would allow you to discount your tax credit. Under the new law, they didn't just modify Section 174 to make amortization mandatory. They also changed some of the language in that Section 280C.
I see.
And basically what they did is they took two paragraphs, and when they rewrote it, they only put one paragraph back in. Now, whether it was a mistake or deliberate, I can't opine, but it created some interesting opportunities for the R&D tax credit itself.
Okay, and you're going to expand on that right now, I think.
Well, the short version is it doesn't
Short
make,
or long, we
Yeah.
have time. Let's see what we got.
the short version is it doesn't make sense to take that reduced credit anymore.
Okay.
Because under the new law, you don't have to make that add back to income like you used to.
Okay.
What you may have to do, if you read the law very literally, is you may have to slightly reduce the amount of that amortizable base
Okay.
under Section 174. And kind of the caveat or the flip-flop there is how much of a tax credit do you have for the current year versus how much of an amortizable base are you dealing with, and how much can you write off in that current year? So let me explain what I mean with an example because it gets confusing,
I
right?
like it.
So instead of saying our tax credit was $100,000 even,
Mm-hmm.
let's say they spent $1 million
Mm-hmm.
on software developers,
Okay.
and the tax credit is $99,000.
Okay.
Okay?
Mm-hmm.
So in that example, because the current year's amortization under Section 174 would be 10%, so that would be the flat $100,000,
Right.
but our tax credit is beneath it, it's $99,000. The way the legislation is written now under the new law, you don't have to make any sort of add back.
Huh.
So there's no reason to take the reduced credit. You can take the full amount of the credit. Essentially, the credit is worth, well, if you do the math backwards, 20% more than it used to be, or 21% more than it used to be.
Wow.
So they increase the value of the R&D credit to help offset this 174 amortization. And that's in addition to that 199A deduction that will increase as well.
Whoa.
So a lot of CPAs are looking at this Section 174 stuff, and they're saying, oh my gosh, this is such a huge sting in terms of, marginal tax increase.
And like what I did in the beginning here before we walked all the way through it, right? I was like,
Mhm.
that sounds really bad. But it's
Mhm.
actually, when you go through all the paces, sounds like then it's going to turn out good.
Yeah, so you still wind up negative, right? So it's not great, but the sting isn't nearly as bad as it looks on paper once you
Face
actually
value.
run it through the whole tax planning scenario.
Wow.
So at least for most small to mid-sized businesses, That takes a lot of the sting out of it. And then as you get to year 2 and year 3, and the amortization starts to stack up, assuming they're spending the same amount of money on software development every year, it will.
For our example, yes.
It will gradually phase in, where you're basically right back where you started.
Wow.
So when we're tackling these R&D tax credit studies now, we have to kind of do like a 3-year to 6-year model where we're saying, okay, it's going to cost you more here, but then you'll make some back here. It's very akin to doing tax planning like we used to do at the CPA firms that I worked at.
Wow.
So a lot of moving parts.
Yeah. And so for our CPA friends who maybe don't do research and development tax credit, this is something where, can you speak to the importance of working with a partner that understands all these nuances?
Yeah, well, it's been kind of an interesting couple of months because we had...
Sounds like it.
So we had to kind of navigate these new waters for the 2022 tax year.
I'm so sorry. Yeah, so that's what I was going to say. So 2022 was the first year so when did this come into play? I missed that part.
Sure. So this was passed back in 2017.
Right, but then now it's just...
But it just phased in for 2022.
Yeah. Okay.
So as we wrap up the 22 filing season,
got it.
That's when, all these poor CPAs and tax preparers out there have had to navigate these uncertain waters.
And you're right. And then they're looking at it like at the one, if they're just looking at 174 or that section without knowing the other places, it's a lot to navigate.
Well, and the real issue with it is it's mandatory, right? It's not optional.
Yeah.
So part of the challenge that you run into is, do I want to come in and do my own 174 analysis, or do I want to wait for the IRS to show up and compute their number?
Yikes.
Which the IRS, they don't have all your data. They don't have all your accounting info just handy, right?
No.
They'd have to come in and either audit you,
right,
or do a short form and say, well, based on what we see in industries and what other folks are doing, this seems like a reasonable number.
Yeah.
And now the burden's on the taxpayer to, disprove it essentially. It's funny. I had a client years and years ago, a high net worth individual down in Mexico.
Yeah.
And he had a
KBN. Yes.
Yeah. And he had a condo in San Diego. It was a nice place, and he didn't get up there very often. Mm-hmm. And he started getting letters from the IRS because he had a mortgage note on the condo.
Yeah.
And they had actually inferred, based on how much mortgage interest he was paying and how long he'd had this mortgage note, that he was making, millions of dollars a year, which he was, to be fair.
Right.
But he had no U.S. tax filing requirement or anything because he lived in Mexico. It was just a vacation home. Mm-hmm. But kind of the goofy rule is, if the IRS sends you a letter, now you have to file.
Yeah.
And so he never went to the condo for like 18 months.
Oh, no.
And in that interim time, the IRS had basically said, based on your mortgage and how much interest you pay, we've decided that you probably make about this much, and we've assessed you all these back taxes, and basically we're going to put a lien against your condo.
Oh my gosh.
And he never got the letters because he wasn't there.
Yeah, because that's not where he was living. Right.
Yeah. And it's kind of a double-edged sword, right? Because on one hand, it's like, hey, it's not my fault. I didn't have any filing requirements, even though they sent me this letter, and I wasn't there to receive the envelope.
Yeah.
But also, if the IRS has to enforce these things, how else are they supposed to do that?
Yeah.
And so I bring up this example, we got it all sorted out for him and everything was fine at the end of the day, and the IRS was actually easy to work with. But I bring up this example because the same is going to be true for Section 174 amortization. Mm-hmm. At a certain point, the IRS is going to look at businesses and they're going to have to figure out some sort of enforcement measure.
Yeah.
And so, best defense being a good offense, I would rather come in and define my Section 174 amounts rather than wait for the IRS to take a pass at it as best they can with the information they have available.
Yeah, because and just to explain that more into some of our audience, if you are a CPA, you're going to track faster. But for those of us, myself included, who aren't CPAs, that's the thing. So they have that information to go off of. But can you explain a little bit about then the numbers, if they come in with it and they're not correct, or it's just based on the information that they have, just the difficulty of disproving it? Just speak to that a little bit more.
Sure. So if they get a letter from the IRS that says, we think it's this, right, and obviously the IRS would give them a chance to respond first. But if they do get a letter that says, we think it's this, now that they have to come through with all the calculations to prove, their version of the 174. Right. And everything has a lot more merit in tax court if it was done at the appropriate time and appropriate place. That's what I was
kind of getting at,
as opposed to, undated work papers in response. I was just reading a case last week where the taxpayer kind of, he was trying to prove his hobby was a business. And one of the big stumbling blocks in the way that he presented his information was he was, pulling all the contemporaneous documentation after the fact rather than having it ready and organized to present to the IRS during the exam.
So what are the types of things? So for us here, when you're going to now prepare the R&D credit, what's changed for us and how we're preparing it? Anything? Or how are we preparing? I know because the amortization, and so that's changed, but anything else, has it changed in how we do it, or we always just have those documents in order and everything that we need?
Yeah, so I mentioned that, it's been a busy year, right? So we had the 22 filing, and then right at the tail end of extension season, the IRS came out with a notice that provided some clarity around what they were seeing and what they expected to see in terms of a 174 analysis.
Right.
Now, a 174 analysis is kind of goofy because it's not very clearly defined in the tax code.
Got it. Sounds fun.
So when we do an R&D tax credit study, we have relatively clear guidance that says, your R&D spend is this, $1 million in our example of the software developers, right?
I like it. Make it easy. Thank you.
Now, when we do the 174 study, we can start with that $1 million, but then there are going to be some changes we're going to have to make.
Okay.
Essentially, 174 allocates indirect costs and overhead. So that $1 million might jump to $1.2 million
I see.
when you start factoring in things like rent, utilities, other things that costs that are incurred relative to that software development activity. So there are some, I don't want to say tricks, but there are some methodologies around, how do you come up with that 174 amount, right?
Yeah.
And nobody really knows. That's kind of the challenge, is it's a very gray area. So the IRS, right before extensions were due, issued some guidance around, hey, here's what we're seeing. Here are some methodologies that we think are acceptable, but you need to be consistent with them.
I see.
And then also they asked for public comment on, what do you guys think?
Really?
Because there is, as I mentioned earlier, a lot of ambiguity in how some of these laws are written now. Where you're sitting there saying, is it a typo? Is it just because we're updating old legislation with new legislation? When they rewrite the tax code, there's all sorts of stuff that goes on where they say, refer to Section C, but Section C's been moved now, so nothing makes sense anymore unless you understand how these updates have, been enacted over the years.
So again, perspective, it sounds exciting. Just kidding.
It's been
sounds
interesting.
Sounds like a hunt, and sounds like you're cracking the code though. But for like you've been in this for so long. That's the thing. It's like working with a seasoned professional. I mean, can you even venture to guess somebody that's like a first year CPA? What should that person do? Like, how would they even be able to track all these different things and nuances? It sounds like you're able to catch it because you've just been in industry for so long.
Well, a lot of it, the IRS, I always say the IRS gets a bad rap, right? So as if the year hadn't been busy enough so far, we had the 22 filing, we had the 174 guidance, and then the IRS came out and said, we're going to be updating the Form 6765 related to the R&D credit.
Okay.
And they're also asking for public feedback again on what that looks like. So the nice thing, if you're not, living and breathing this stuff every day, is at least the IRS is doing a good job of telegraphing, these are the things we're not sure about.
Yeah.
They're trying to offer like a reasonable path. I don't know that to compromise is the right expression, but at least they're trying to steer folks in the right direction and keep the good actors moving on the right path.
That's good.
Now, the new form's interesting, though, because they added 2 additional pages.
Okay. Wait, so let's back up too. So that form name again?
6765 is the R&D tax credit form.
And that's just always been, what were you going to say?
Oh, I was going to say the credit for increasing research activity, right? If I'm using the proper name for it.
We must use proper names here only. Yes. So thank you so much. Even though I call it, I'm like the R&D tax credit. I mean, that's colloquially, that's
what everybody calls it. Absolutely.
Okay. But if you're a super nerd, it is unacceptable. Just kidding. I actually appreciate it just for educational purposes. It is great to know what it's actually called. And so thank you, Rob. But I'll keep referring to it as R&D tax credit.
That's fine. Everyone else does.
Yeah, I'll be one of the many. But in that, so that form is just historically, that is just a form that is used year in year out for the R&D tax credit.
Right. And so after the passage of the PATH Act in 2015, they added a Section D where if you were essentially a small startup company.
How many sections do these things usually
Uh,
have?
you-
Is
you
it
don't
like,
wanna
and then
know.
section M1, M2, like how many
Oh yeah,
sections?
those are schedules, absolutely.
I can't. Okay, so go on. So that's good.
Mm-hmm.
So it's just down in section D. So we're doing good. Got
Yeah,
it.
so we made it.
Tax,
We finally made it to
section
the
D.
bottom of page 2 of the form,
Okay.
and now they have 2 additional proposed pages.
Awesome. Good.
And these additional proposed pages include things like business components and essentially a lot of the more controversial things that have been going on with the R&D
Yeah.
credit that weren't always mandatory are now going to be mandatory. So to the point we were discussing earlier, the IRS is telegraphing where they're moving with this particular tax credit.
How are the new forms different than the old forms?
Yeah, so historically, the IRS has had issues enforcing whether or not an R&D tax credit study is done correctly,
Okay.
right? So the old form basically just takes the numbers out of the study itself and puts it on the return.
Okay.
And so one thing that you run into is there wasn't actually like a detailed write-up analyzing the business activities as part of the tax filing. The assumption was the taxpayer was maintaining some type of report that fundamentally says, this is what we did, this is why it's R&D, and here's how we figured that out. What we're seeing in practice,
Yeah.
and in response to this new form where you actually have to outline the business components and explain the business activities in greater detail,
Yeah.
is a lot of CPA firms are pushing back.
Okay.
And I can only assume that that's because maybe they aren't necessarily doing the full documentation that one would normally expect to go with an R&D tax credit study.
I mean, you guys, we're expert here at doing that. It's a lot, and you have to be very aware of how to document properly. Would you say that's the case?
Yeah, well, it's always, I always kind of smile a little bit.
Yeah.
Because
Smiling's good.
Yeah, because you see these folks out there and they say there's been a great dramatic change to the R&D tax credit, not just about this form, but about a number of things over the years.
Yeah.
Pretty much anytime a new R&D tax credit court case comes out, they say,
Okay.
oh, there's been a huge change.
Yes.
There are, the occasional cases that are interesting, but for the most part, this requirement that a business have business components
Yeah.
and projects that are being evaluated, that's nothing new. That's been around for a long time. So the idea that somebody would be claiming an R&D tax credit and not documenting the projects, I don't want to say you reap what you sow, but you kind of create that liability or exposure by not engaging in the appropriate documentation.
Yeah.
So when we saw the form, we all kind of high-fived because this is the same stuff we were already doing.
Nice. Go on.
So it's an issue of more details going to have to go into the tax return, sure. But we already have that ready in our reports. We're already
That's
analyzing
so
the
cool.
business components and looking at the projects and activities of the taxpayer, as opposed to kind of a back of the napkin, hey, this is what we think the numbers come out to, and we'll worry about it if you ever get audited. Not really the approach we like to take here.
No, but I get why it'd be like that, just because there's so much to do. I mean, just for a CPA to prep taxes, and then if you're looking at these tax credits and incentives, there's just a lot to do in general. So then you look at somewhere like here where we specialize in these tax credits and incentives, and then we can really build out a proper process. But I think that's pretty amazing that we were already doing what is a new requirement. And the thought behind it was just so that we could be prepared, correct? Like what you were saying, so we could be ahead of everything. Like if an audit came in, we just would have it all ready to go, which we
Right.
also do for ERC, actually. So it's kind of our approach, is just to have everything documented, substantiated, and all in order.
Yeah, well, we were talking earlier about, you don't go put together contemporaneous documentation
Yeah.
after you get the letter from the IRS. You already have it ready to go.
Yeah.
With the R&D credit, it's been kind of interesting to see as the IRS does win in tax court, and you always kind of chuckle a little bit when you see some of these cases. You'll see a vendor say, hey, we successfully defended, $200,000 or $300,000 in R&D tax credit claims.
Yeah.
They don't mention the fact that the claim was for, $2 million or whatever it was, and the IRS, basically knocked out most of the tax credit.
Wow.
And sometimes the folks that do these studies, they're very reputable CPA firms,
Yeah.
but the IRS expects you to maintain a certain level of due diligence.
Yeah.
And if they're not working with the IRS and they're not willing to compromise, and there's this shrink back rule where you have to be able to say, well, here's what we're talking about underneath this broad category, the IRS has no choice but to disallow the credit in full. And over the last 5 years, we've seen a number of cases where the R&D tax credit was disallowed because the business component documentation was inadequate. So it's really no surprise that they're pushing for this. So about 2 years ago, the IRS said if you want to file a retroactive claim for the R&D tax credit, because obviously you can go back a couple years federally, you can go back 3 years for a refund.
So just real quick, because our CPA friends will know that, but for anyone else, it's that it can be in say we're coming in to work with a client, it can be a look back of 3 to 4 years, correct? State dependent?
Yeah, federally it's a 3-year statute. Here in the state of California, it's 4 years, but most states conform to the 3-year statute that the feds have.
They're not non-conforming with the dyed hair and the earrings. Anyway, lame joke again, but it's sticking with me. So the thing is for that though, so that would come in the form of a refund, and then years moving forward, it's an offset in tax liability, correct?
Yeah, exactly. Okay. So if a business has never claimed the R&D credit, and to this day I still meet folks where they've been in business for 40 years, 60 years, make tons of money, and I shudder to think how much they left on the table by not claiming this credit over those years.
I love your phrases, Rob. I'm like, I shudder too. Yeah. I don't like it either. I love your phrases.
Oh, well, my mother-in-law's British, so that might be where I get some of it.
So that's good. But it is, on a serious note, like it is a big deal. And that's what I was going to say. I don't think we said it in the beginning. Again, because if our audience has CPAs, I'm sorry if some of this they're going to know this, but this thing of, in the R&D tax credit, I already forgot what the real name is. So in the R&D tax credit, it's one of those things where I like that saying, it's not new to the world, it's new to you. So like in the 80s, I think it was like 81, it was the 80s when it was originated, the tax credit, R&D, but it was new to the world, right? And then it moved into new to you. So it's just innovation within the business.
Yeah, correct. So it doesn't have to be curing cancer. There just has to be some sort of technical, scientific type unknown, an engineering unknown that the business seeks to resolve.
Yeah, I like it. So it can be broadly applicable in the right industries.
But again, it's all tied back to what are the projects you're working on and how do we break those up into business components and are we documenting them?
Yep.
So about 2 years ago, the IRS came out and said for all these retro claims, these refund claims, retroactive claims, you have to provide this additional information. What are the business components? Who worked on those business components? What were the unknowns they sought to resolve as a function of that work?
Yeah.
So for any refund claims, the IRS has already imposed this requirement.
Wow.
Citing actually a tax law that has nothing to do with R&D credits, but just if you look at the way the law around a refund claim is worded, it says you have to lay out all the grounds upon which the claim is based when you submit it for consideration. And so they've had kind of this, again, kind of a gray area with the IRS where they said, well, based on that, we have the authority to require this as part of an R&D refund claim.
Yeah. Which sounds like it's actually good because it'll be protective if they have to submit all that documentation and the IRS comes from an audit. So it's protective in nature, or it makes it.
Yeah, well, it's kind of a double-edged sword for a tax practitioner because you need to make sure the information that you include in that refund claim aligns with anything you would do to defend the claim itself, right? So you have to put your best foot forward with the IRS. You can't go back and change your story down the road.
Yeah.
So as the IRS goes through this, they found a way to require that for retro. And then from an administrative point of view, they figured out a way to take a law that does have some nuance to it, some gray areas, if you will. And they said, well, if we have the administrative ability to update the form to require these things.
Yeah.
And so they're figuring out a smarter way to review the tax credit, if you will.
Yeah.
And they're doing it within the powers that they have because they have to take the legislation as it's written and figure out how to police and enforce it effectively.
Wow. It's a lot going on.
Busy year.
Yeah, a busy year, but good for us here in that having people like you to understand actually what the amortization means and the different sections that apply to it and how to work it all out, and that we were already doing everything needed for the new form. That's pretty amazing. So
yeah, well, every once in a while you feel pretty good when you're trying to figure it out and you realize the IRS is staring at the same code section and they're squinting a little bit too, trying to figure out how to enforce it. The Section 174, one of the methodologies that we employed in doing our analyses this year was based around square footage.
Okay.
And it was nice to see in the IRS 174 guidance that they said, yes, square footage is a reasonable way to tackle this issue.
That's great.
So I think we're all looking at the same piece of legislation and trying to figure out, how to be good actors in the space.
And I think you were saying to me something, too, what is nice with the IRS is that they will have an effective date. So say if they come in to enforce, but it had been gray, and then it gets a little bit less gray. They'll say, hey, effective from now, we've figured out this is what we're looking for, and on a go forward, this is what we'll be looking for. Can you speak to that a little bit?
Yeah, that's true of the IRS, but not just the IRS. So every time a piece of legislation gets enacted, they don't necessarily think of every possible scenario or every affected constituent or taxpayer.
Sure.
Right?
Yeah.
And so when we look at different programs, like even the Work Opportunity Tax Credit.
WOTC, yeah.
Yeah. So when you look at the R&D credit, that was made permanent, but it used to be something that was extended every couple of years.
That's right.
The Work Opportunity Tax Credit is still in that boat of being extended every couple of years. So right now that expires at the end of 2025.
Right.
But there have been instances with WOTC where it expired because they couldn't pass a bill to renew it.
Oh.
And then it was extended retroactively.
Wow.
After the fact. Now, you can imagine how convoluted that gets, because when we're submitting WOTC certifications for businesses, we're having a 4-week window to get an employee certified, right?
Yeah.
So you have to kind of screen them on a rolling basis and submit the cert. So if the tax credit expired at the beginning of the year, do you keep screening even though it's expired?
Yeah.
And do you keep, documenting all the qualified hires?
Yeah.
And so I bring that example up because when they did finally extend it, then you had to create an amnesty window where you say, hey, because it's retroactive, now you can go back and submit all the stuff that hopefully you were capturing along the way. So that's the challenge that any government agency deals with when they're trying to actually implement a piece of legislation that, sounds good in Washington, D.C., but when you get to boots on the ground, how do we make it something that's approachable? And so part of that often is kind of a phase in, or claims submitted up to this date are subject to these old rules, and claims after this effective date are subject to new rules that we've laid out here in whatever administrative guidance we're providing.
That was a nice explanation. And in that, for us here, that's the thing that I've heard as a theme, though, is just having the best foresight or knowledge that you just have the documentation as clear, lined up, ready as you can. Would you say just simply that is correct?
Yeah, absolutely. I think, tax preparers are very familiar with starting with like here's what our P&L looks like today, or here's what our trial balance looks like today. And how do we get from the accounting records that have been accumulated throughout the year to an income tax return?
Yeah.
And what do our, Schedule M reconciliations look like, and everything else that says this is what our accounting software says, but this is how we have to report it at the federal and state level, and then federal to state tax differences too. Mm-hmm. We talked about earlier, if you have a lot of shareholders and a flow-through entity, or if you're in multiple states, pulling a string over here can just lengthen a string over here. As you shorten one side, you lengthen the other. Yeah. And we've seen that with, especially when you have multiple states, shareholders in those multiple states, and they're all subject to local state laws, where they might be getting a credit for something that's happening in one state, and then when you change the activity in that state, their home state says, fine, we're just going to tax you more, or vice versa. So there's a lot of give and take that you have to be cognizant of when you're evaluating, do we document this credit, or do we take this depreciation? Or, what tax accounting methods do we want to use?
Yeah, that's right. So bringing it back then to R&D for us, with this 174, with the amortization and the changes that have been made, about how long is it taking us to complete studies now?
So the study duration hasn't really changed. A lot of it's dependent on the client themselves. So depending on how readily available the documentation is, we had one we turned around in a week.
Wow, that's a good business owner.
and we have others that take months and months to complete. Right. Generally, I always say, get your data in early so we can start stacking it up the way the IRS wants us to review it. And that way we're not rushing at the end of the year to try to get everything done.
Yeah, for the filing. That's good. And then just a couple more questions. I was going to say for our CPA friends, or if people are confused about, because you laid it out well. So if somebody wants to know more about how all of this interacts, how would you advise somebody to go about learning?
Yeah, so we have a lot of great information on our website, actually, but we're always just a phone call away or an email away. I always joke that, especially during filing deadlines, my phone is like the bat phone, right, for CPAs, whether they're in Lacert or UltraTax or Pro Systems or whatever. How do I find this checkbox, or what do I need to do to get this tax credit in? Or I got a K1 with no supporting detail. How do I put it into the shareholder's return? We get all sorts of calls like that all throughout the year, but especially, at the 11th hour during tax filing when everyone's under the gun. And we're just happy to be a resource to folks, especially practitioners, because having worked at CPA firms over the years, I know what it's like being there at 11 p.m. midnight trying to get something done on a tax return.
Yeah, and that's what I like to hear. So if people are interested in learning more about R&D, or if they're thinking, I was talking to a CPA who was doing R&D in-house, but then was like, hey, I just want to move to outsourcing it just so I don't have to keep up with everything going on. So if somebody is interested in working with us, that approach would be what? Would they be able to just talk to you about it? What would you say to that?
Absolutely. They can talk to me, or they can talk to someone from my team. We don't charge anything to do an assessment, so it's not like we start the clock as soon as the phone rings. I always say one of the biggest value adds that I have, or someone from my team has, is we help you figure out when it's not applicable, right? So there are so many fact patterns where you might walk into it and figure out, hey, this tax credit, it's not really worth pursuing. I'm not structured correctly for it. There's a number of ways where you can, or maybe I just didn't spend enough on qualified activities, or my contracts with my vendors or clients disqualify me, whatever it might be. We'll help you at least gloss over it and figure out if there's something there worth pursuing.
Yeah, and then too, for people that might want to partner with us, can you speak to us helping them determine which of their clients might be a good fit?
Yeah, so we're happy to spend time, narrowing that list down and identifying these are the key folks that probably could benefit from these programs, as well as these are commonly overlooked things.
Oh, that's a good one.
So yeah, I think of everything.
See, that's exciting. That goes in the exciting for me. Yeah.
Well, the one I like at this point in time, this day and age, pretty much any larger company is a software company, like it or not.
That makes sense.
So they're going to have some kind of technical spend. Now, whether or not it's material for the R&D tax credit, or whether or not it makes sense to pursue, that's another question.
But you want to look under that rock.
Mm-hmm. So larger companies, advertising, typically they have a lot of software developers and web developers on staff these days, so they often overlook it because they think, what does advertising have to do with research and development, right?
Right, yeah. What does it, Rob?
What doesn't have to do with learning?
No, I'm saying, what does it have to do, Rob?
If they have folks that are writing code and developing software just lends itself very naturally to the R&D
Which
credit.
Is great.
The average annual tax expenditure for just the federal government, not counting the state programs, is up to about $17 billion with a B. It's a lot of money. And if you look at the primary claimants for the tax credit, it's manufacturing and processing and software development.
Wow.
So software dev, you can kind of see if you think about the iterative nature of writing computer code. We write some code, we test it. Did we achieve the desired outcome? Do we need to revise the technical specifications? Right? It makes a lot of sense. Manufacturing and processing, a lot of times those folks will overlook it.
Yeah.
So if you're just thinking about it generally, if we're taking something physical in and we're doing something to it and producing some sort of product, there's the potential for an R&D tax credit there.
That's great.
I always give the example of a client I had years and years ago, a door and window manufacturer. And you say, well, how much R&D can really be going on with doors and windows, right?
Yeah.
Like you measure once, cut twice, or vice versa. But these folks had purchased a building and they had bought a lot of equipment, new equipment.
Yeah.
And they had to figure out, how do we run the equipment? How do we set it up? Is the wood becoming brittle because we're using these new chemicals? What ratio of chemicals do we use? So for a number of years, they actually had highly compensated individuals, trying to resolve these technical unknowns for the business.
Yeah.
And so for a couple of years, they had a very significant R&D credit. Once they ironed it out, sure, there might be some process improvement type stuff going
But for
on, but
those
the credit was
years.
significantly less than
Yeah,
it was
sure.
as they moved into this new space and learned to use this new equipment in
Right,
the
right.
manufacturing process.
Yeah, but for those years that they were doing the heavy spend on figuring out what works, that's a great source to use for the R&D tax credit. So that's great.
Yeah, I always say with the R&D credit, it might not be good for the business, but failure is a wonderful thing when we're trying to document, what the technical unknowns were that we sought to resolve.
That's actually really funny, and I do like that because it's rewarding business owners exactly for innovation. So then making it where they might be more willing to try and improve, which is the point of it, really, here in the U.S. I love it. Okay, so to everyone, I learned a lot. I hope you did too. And with that, any final words? Anything you want to leave our friends with?
Yeah, my one good dad joke.
Yeah.
So, two jumper cables walk into a bar, and the bartender says, "Hey, pal, don't start anything in here."
And with that, I think that's an excellent